Let's jump right into our journal entries. First thing I'm going to do is I'm going to label each entry so we know exactly which one we're doing when we look back at this. Starting with B here, I'm going to go ahead and write down the date. You can go ahead and write down the year if you like. I'm going to skip that since I have limited space. So B, as you recall, involved Lori visiting the bank and securing a loan of $4,000. So if you remember what we did on our T account, we made a debit posting to cash. So this is no different. We're going to have our debit right up against the left margin once we've written down the date. And we will have $4,000, which is the amount we got from the bank. And our credit, indented slightly to the right, I'm going to write down bank loan. And we're going to have a credit of $4,000. And a brief description, nothing too fancy. I'm just going to write down secured a bank loan. Okay, moving on to C. I'm going to leave a line here and start down here with January 12th. And here we have Lori purchasing merchandising inventory on account for $2,500. So once again, we're acquiring an asset. This time the asset is inventory, so we'll debit it to make it go up. And as we know, when we buy something on account, we're going to pay for it later. So we have accounts payable. Credit 2,500. And just make a brief description. Inventory purchase on account. So D, we have a customer coming in to buy $1,000 worth of goods on account, and the goods it cost us $700. So recall that this is the special entry where we need two journal entries. So starting with D1, January 15th. We will have accounts receivable, since our customer will be paying us later. And of course, sales revenue. And we're going to make a brief description. merchandise sold on account. D2, January 15th. Running out of space here, so I'm going to scroll up a little bit. We have our second half of this transaction, which we're going to journalize, which is the actual cost of the inventory we sold. And luckily for us, this was only 700, so we were able to make a profit on this. And what did we lose? We lost some inventory. Once we sold that inventory, it no longer belonged to us. So we take it out of our asset base by crediting it. Once again, we need a nice little note to describe the transaction. I'm going to go ahead and write down the same note I had for D1. Merchandise sold on account. E, Lori paid her supplier for the January 12th purchase. And this was on January 27th. When we pay somebody a balance that we owed them, we debit our accounts payable. Since we no longer owe that liability, we paid in full, the full amount goes away, and of course, we pay with cash. A brief description. Payment for Jan 12 order. And finally, we collect money from our customer on January 31st. When we collect money, of course, we get cash. And since Eric no longer owes us money, we will credit his account receivable to take it off the books. And one last description here. I'm going to put down January 15 order collection. Okay. Looking at the next portion here, we have a definition. A ledger is a grouping of all the T accounts and the balances. So back when we made a group of 8 T accounts, we essentially made a general ledger. The journal does a good job of showing transactions, but isn't great for showing account balances. For example, what if a business owner wanted to know how much cash was on hand without having to do a physical count of all the bills and coins in the cash register, and also having to call his banker? This would be a wasteful method of figuring out the cash available, especially if you have to do it repeatedly. Posting is the process of transferring data from the journal to the ledger. When we update the ledger with new information from the journal, we are posting to the ledger. This is effectively a reverse process to what we just did by filling in the T account and making journal entries after the fact. We did this process backwards to obtain an understanding about journal entries and T account, but the normal accounting process involves making journal entries first and then updating the ledger with data from the journal. Since we have already completed this process for Lori's firm, let's look at some new journal entries for Ken's bike repair. Ken repairs bikes for bike rental outlets all over the Vancouver area. He receives large volumes of work at a time. So here we have a bunch of journal entries. Let's go through them really quickly. So May 5th, we have equipment purchased with cash. So we can tell this by looking at the debit and credit, or we can simply just read the description down below. May 7th, we have accounts receivable, debited, and service revenue. This is bike repairs done on account. We have salary expense and cash. This is salary paid to an employee. And we have on May 17th, cash exchange for accounts receivable. This is switching one asset for the other. That's a collection of accounts receivable. May 19th, we collect cash and we credit an account called unearned service revenue. This is basically a customer paying in advance. And May 25th, we debit unearned service revenue and credit service revenue. This is us fulfilling our liability and completing the work. So before I go down to the T account, I'm going to make life a whole lot easier for me by putting letters beside each one of these transactions, making them really easy to refer to in the T account. So A, B, C, D, scroll up, E, and F. Okay. So here we have our T account and we have our journal entries nicely labeled. What we're going to do is we're just going to transfer information from the journal entry to the T account, and then we're going to go through the whole process of adding up our T account at the end to determine ending balances. So take a few minutes to do that, and we'll proceed in the next video.